Today we're going to delve into some shocking news about the banking system. It seems that optimism in the banking industry is being overshadowed by a growing mountain of bad loans. This is no small issue either. The last quarter of 2023 saw non-performing loans for major banks like JPMorgan Chase, Bank of America, Wells Fargo, and Citigroup rise to a staggering $24.4 billion. That's a $6 billion increase year over year, folks, but that's not all. To deal with this new business climate, banks are resorting to cost-cutting measures, including layoffs and severance packages, and even though bad loans are on the rise, these banking giants are actually reducing the amount of capital provisions they set aside for future non-performing loans. It's a complex situation with far-reaching implications, so buckle up as we dive into these turbulent financial waters. The banking industry is currently facing a rising tide of bad loans. This isn't a statement to be taken lightly. Bad loans, also known as non-performing loans, are loans where the borrower is not making interest payments or repaying any principal. In the last quarter of 2023, non-performing loans for JPMorgan Chase, Bank of America, Wells Fargo, and Citigroup, some of the biggest names in the industry, rose to a staggering combined total of $24.4 billion. Yes, you heard it right, $24.4 billion. This represents a $6 billion increase year over year. Now, what does this mean? This increase in bad loans indicates that more borrowers are defaulting on their loans. And this, in turn, is causing a significant dent in the banking industry's profitability. Interestingly, despite the rise in bad loans, these banking giants are reducing the amount of capital provisions they set aside for future non-performing loans. This is a risky move, as it leaves them exposed to future losses if the trend of rising bad loans continues. Major property investors are also starting to feel the heat. Some are walking away from their mortgages, which could lead to more defaults on loans. This is not just a problem for the borrower, but also for the banks, as they are left with properties that they have to sell, often at a loss. In the third quarter of last year, U.S. banks faced higher losses on loans designated as unrecoverable compared to the previous 3 months and the previous year. This paints a grim picture of what's to come if this trend continues unchecked. This bad loans crisis is a ticking time bomb for the banking industry. And like any time bomb, the question isn't if it will explode, but when. To deal with this new business climate, banks are resorting to some drastic measures. Let's dig deeper into this. Faced with an impending financial crisis, banks are turning to cost-cutting strategies. One primary measure being implemented is layoffs. Yes, you heard that right. Banks are reducing their workforce in an attempt to manage the financial strain. This is not just about cutting costs, but also about survival. But what does this mean for the employees? Many skilled and dedicated workers are finding themselves without a job. And in an economy that is already under stress, finding new employment can be a daunting task. This is a direct impact of the banking crisis on everyday people, and it's a stark reminder of the human cost of financial instability. In addition to layoffs, banks are also offering severance packages. While this might seem like a kind gesture, it's important to remember that this is another cost-cutting measure. By offering these packages, banks are hoping to encourage voluntary resignations, reducing their payroll expenses while avoiding the negative publicity that often accompanies mass layoffs. But it's not just about the employees. These cost-cutting measures also have a significant impact on the operations of the banks. With fewer staff, banks may struggle to maintain the same level of service. This could lead to longer wait times for customers, slower response rates, and a potential decrease in customer satisfaction. While these measures might help banks stay afloat in the short term, they do not address the root cause of the problem: the growing pile of non-performing loans. In fact, by reducing their workforce and potentially lowering the quality of their service, banks may even risk losing more customers and further exacerbating their financial troubles. These measures show the desperate situation the banks are in. It is clear that the banking industry is in a state of turmoil, and these cost-cutting measures are a stark illustration of the lengths banks are willing to go to in order to survive this crisis. The crisis doesn't stop at the big banks. Regional banks are also at risk. Let's delve into this concerning situation. Regional banks, those financial institutions that are smaller than the major national banks but still play a vital role in our economy, are finding themselves in a precarious position. The culprit? Their significant exposure to the troubled commercial real estate industry. See, regional banks have about 18% of their loan portfolios tied up in this sector, and why is this a problem? Well, the commercial real estate industry is currently treading water. With a shift towards remote work and a decrease in demand for physical retail space, commercial property values are under pressure. This poses a significant risk to regional banks. If property values decline and commercial real estate borrowers can't meet their loan obligations, these banks could face substantial losses. But the threat doesn't stop there. Major property investors are starting to walk away from their mortgages. You might be thinking, so what? That's their problem, right? Well, not quite. If these big players default on their loans, the banks that lent them the money are left holding the bag. This could result in a domino effect. Imagine this scenario. One major default leads to a bank's financial instability, which in turn prompts more investors to default, further destabilizing the bank. This cycle could repeat itself, posing a real threat to not only one but multiple small and mid-sized banks. So, what does this mean for the banking industry? It means we could see a ripple effect that starts with the commercial real estate industry and ends up shaking the foundation of our regional banks. And as we all know, when one domino falls, it's hard to stop the rest from toppling. This could lead to a domino effect, leading to defaults on loans and posing a real threat to small and mid-sized banks. So, what does the future hold for the banking industry? Given the current trends, the outlook is far from rosy. The pile of bad loans is growing. And it's not just the big banks that are feeling the pinch. Regional banks, with a significant portion of their portfolios in the troubled commercial real estate industry, are also at risk. Major property investors are starting to walk away from their mortgages, which could lead to a wave of defaults. This could potentially destabilize smaller and mid-sized banks, creating a ripple effect throughout the economy. As the banking industry grapples with this crisis, cost-cutting measures are likely to continue and even intensify. This could mean more layoffs, more severance packages, and potentially less capital set aside for future non-performing loans. However, this approach may only provide a temporary solution. If the number of non-performing loans continues to rise, the banks may find themselves in an increasingly precarious position. The impact of this crisis will not be confined to the banking sector alone. It's likely to reverberate throughout the economy, affecting businesses and consumers alike. Businesses may face tighter lending conditions, making it harder for them to expand or even maintain their operations. For consumers, the effects could be even more direct. Higher interest rates, stricter loan conditions, and a potential decrease in the availability of credit could all be on the horizon. But it's not all doom and gloom. Crises often act as catalysts for change, and this could be an opportunity for the banking industry to reassess its practices and make necessary adjustments. Perhaps a shift towards more sustainable lending practices is needed. Or maybe it's time for the industry to embrace new technologies and innovative solutions to better manage risk. The banking industry is indeed in troubled waters, and we will need to brace for what's to come. That brings us to the end of our analysis of the banking system's current situation. We've delved into the surge of bad loans, the drastic cost-cutting measures being implemented by major banks, and the looming threat to regional banks. This is a complex and evolving situation, and it's crucial to stay informed. The banking system is a cornerstone of our economy, and its health can have far-reaching implications. We encourage you to keep abreast of these developments, as they can significantly impact your investments and financial decisions. Remember, knowledge is power, especially when it comes to finance. Thanks for watching, and as always, happy investing. Don't forget to like, subscribe, and ring that notification bell to stay updated with the latest videos.